Hi, everyone. I am Nadia Kachwaha with Coldwell Banker Realty in Connecticut, and I'm here again today with Sam Kline with Coldwell Banker Commercial Mecca out of the Charlotte, North Carolina metro area. We've had a couple of these conversations in the last few weeks, and today we're going to talk about the benefits of real estate investing. So, Sam, you want to jump right in?
I will. Thanks again for having me. So we kind of narrowed this down to three topics. We're going to start with the idea that real estate provides passive income. Um, the idea here is that if we own a piece of real estate properly, we're making money on Christmas Day, we're making money while we're on vacation. The real estate ultimately generates an income for us. What are your thoughts on passive income?
Well, just for those that don't actually know what passive income is, it's income that requires little to no effort to earn and maintain. And this is why real estate investing is great. If you have a building and you rent it out and you're collecting rent every month, yes, there's some initial investment that goes into getting the property ready for rent, and then there's the time that you spend or the money you spend to get it leased out. But once that's done, you should really be collecting rent every month, and that's passive. You're not working for that rent every month. So I love passive income.
I'm a fan myself. I think the important thing to remember about passive income, if we've ever experienced any kind of real estate marketing tools where there's lots of like instantaneous get rich quick ideas, generally speaking, the returns on real estate are slow and steady. We're dealing with a crock pot instead of a microwave. So beware of the idea that you can quit your job and double down on a property with a little bit of money and make enough money to create an income. Generally, if we talk about a very simple investment, single family home, we might cash flow $300 or $400 a month off our first deal. Let's just pretend. And so that's not enough to quit. But if we do that enough times, not only do we have more income, we can start to afford management. And once we can afford management of our portfolio, that's when it really does become passive. We're no longer dealing with repairs or looking for tenants. We're just truly collecting rent every month. So real estate is a great way to create passive income.
Absolutely. And remember, you want to work with someone that has the experience, because if it's too good to be true, if you're just getting into investing and it seems too good to be true, it probably is. Some people get in over their heads in the beginning. So make sure you're talking to someone that knows how to analyze the investment and is taking into account all the costs that you might have going into it. So
It's a
just
great,
a little.
it, that's a great point, and probably a reason why single family homes are a great place to start. They tend to be scalable. If you haven't done a huge project, they're smaller in nature and easier to manage, and there's less risk. And again, we talked last week about how much easier they are to sell if necessary. The second piece of real estate that's great from an investing standpoint is appreciation. We kind of talked before we started recording about what does appreciation mean? What does it mean to you?
Well, the like textbook definition is the increase in value of an asset over time. So appreciation is not the cash flow that you're getting every month; it's the actual value of the asset. So if it was worth $150,000 today when you bought it, and you're going to sell it in 5 years, are you going to be able to sell it for more than 150,000? Is it going to be worth more in that market? That margin, say it's worth $200,000 in 5 years, it has appreciated by $50,000. So that's what appreciation is. And it's another great reason to invest in real estate, because if you have a strategy that you want to sell in the future, or if you want to leverage that property and borrow on it, appreciation matters.
The thing I wanted to talk about is the idea that there's always appreciation or that it's always consistent. And so you and I were too young in the 90s we were alive, of course, but we weren't involved in real estate during that downturn and we wouldn't have experienced it. But we were both involved. I was involved in the construction industry in '08 and you were involved in the real estate industry. That was a crazy time. I remember from a construction perspective, there's tons of competition, much lower margins. Of course, from a real estate perspective, people experienced major losses and had to move on from properties. Banks called notes. And now, oddly enough, it's 2020 and we're living through yet another downturn where I do believe that there's going to be a little bit of a reset in pricing. And so the important thing for our listeners to understand is that real estate does tend to appreciate by about 4% a year, but that appreciation isn't always guaranteed. And we need to make sure that we're not leveraged in a way that won't allow us to sort of ride out the storm and sell at a later time. major investors do depend on appreciation and generally analyze property with a holding period, say 5 years or 10 years. But it's important to have flexibility within that and not be forced to sell.
One quick thing, just talk to someone in your local market. So Sam's saying that there's maybe a correction in pricing in my market in Connecticut, and definitely in the residential and multi-family residential side, we are not seeing a price decrease. We are seeing increases in pricing. So just talk to who you trust in your local market.
Charlotte's wide open as well, and we haven't seen that correction yet, but I think it's coming. And the last piece, of course, is tax benefits. We did touch on this in our first segment together. Very important to understand that we can deduct interest, points, and depreciation from income. So if we take a property and we leverage it, meaning we borrow money against it, especially in the beginning when we're paying a lot of interest, and we remove that from the income we collect, we remove, again, points on the loan and also depreciation of the property, which the IRS forces us to take anyway, we can really change the taxable income that we pay on. And so if we're talking about someone who's a really big wage earner and is paying in that 37%, oftentimes with a larger investment, we can lower that down in the 20s. Now, I'm not an accountant. I don't like to pretend to be either, and you need a good one to advise you on it. But those are some simple rules, tax benefits for real estate that the IRS allows are very advantageous to the right person.
And I think that's an important point. We're going to go into more detail. We're planning a webinar sometime in the future. We'll let all of you know, and we'll touch on this point a little bit more, maybe with some spreadsheets so people can see what we're talking about. But for now, those are our 3 main benefits of investing in real estate. Next week, we're going to talk about leasing from a tenant perspective. So please listen in next week as well. Sam, as always, thanks for joining me.
Thanks for having me. That was great.
Bye.